RESPA, what do you need to know? Let's talk in depth today about RESPA, the definition of a mortgage broker, loans that are covered under RESPA, what RESPA prohibits, limits, and allows. We'll talk about settlement services, the foreclosure process, escrow statements, and we're going to round it all out by talking about what you absolutely must know about RESPA for the exam. Let's get started. RESPA's origins and purpose. RESPA was enacted in 1974 to protect home buyers, and it was really in response to excessive fees and hidden settlement costs that were occurring in the settlement and closing process. The first thing was to create transparency about loans and the costs associated with them. So it created the GFE, or the good faith estimate, where we have to provide an estimate of the settlement costs. We'll talk about that more in the TRID section. But it also creates the HUD-1, where it shows exactly where the fees are going, and it creates transparency around where money goes on a loan transaction. Similarly, it prohibits referrals and referral fees and kickbacks. We'll talk a little bit more in depth about that. It limits the amount of money that can be held in escrow accounts. It also requires that we analyze the escrow accounts. We'll talk about that too. And it standardizes the settlement process so that borrowers are able to shop around for title and other services. The major impact of RESPA, though, is that it reshaped mortgage lending by creating greater consumer protections and clarity. Under RESPA, there's a definition of a mortgage broker. And a mortgage broker is someone who provides loan origination services by acting as an intermediary, that is a go-between between a borrower and a lender, but is not an employee of the lender. For instance, if I am working with a borrower and I refer them to a lender, I am by definition a mortgage broker. Now, it's important to understand that under RESPA, they also consider table funding to be a form of mortgage brokering. Table funding occurs when a lender sends a wire to the title company instead of the lender using their own warehouse line. Under RESPA, if a loan is table funded, then it is considered to be a brokered transaction. It is not a lending transaction. And that's important to understand because there's requirements associated with mortgage brokers. Remember that RESPA is known as Regulation X as well. In terms of applicable loans under RESPA, RESPA is going to apply to most federally related mortgage loans. That includes first lien and subordinate lien loans, 1 to 4 family dwellings, and that'll include co-ops, condos, manufactured homes, and a little asterisk there, manufactured homes as long as they're taxed as real property. Federal loans or loans that are intended to sell to Fannie, Freddie, or Ginnie, all covered under RESPA. Any loan that you're doing as a mortgage loan originator will be covered under RESPA. It's important to understand, though, that some loans are exempt from RESPA. So if you have a vacant land loan, that would actually be exempt under RESPA. If you were to do temporary financing, including construction loans or bridge loans, that would be exempt under RESPA. Note, however, that construction to perm loans, that is a construction loan that automatically turns into a permanent loan or a 30-year loan, that is not exempt under RESPA. Additionally, commercial loans are also exempt under RESPA. So would personal loans. Those would also be exempt under RESPA. In terms of RESPA prohibitions, limitations, and exemptions, RESPA prohibits kickbacks and unearned fees. What is a kickback? That's a referral fee that is received when you refer someone to someone else. So if I am a mortgage loan originator and I refer a borrower to a certain title company, I cannot be paid for making that referral. I can't receive any sort of payment, any sort of thing of value. And under the law, a thing of value does not necessarily mean transferring of money. It could be a vacation, that could be a gift card. It's pretty airtight in terms of what can be offered. So nothing that is anything of value. So make sure you understand that. Referral fees cannot be charged. You also can't charge fees for services that haven't been performed. So if I am a mortgage lender, I can't charge a fee for something that I didn't do. There has to be real work performed in order for those fees to be charged. Now, I can, however, be a mortgage lender and own a title company, and that's where we get to the affiliated business arrangement. So if there is at least 1% or more common ownership between a title company and a mortgage company, that's the most common example, but really it's any settlement service provider, then an affiliated business arrangement must be disclosed at the time or before the time of making the referral. So the affiliated business arrangement disclosure exists to say, hey, look, you have the right to shop around. You don't have to use this provider, particularly for title. And that will occur whenever there's 1% or more common ownership. once more, that is at the time or before the time of making the referral that you must disclose your affiliated arrangement. In terms of other RESPA prohibitions, seller cannot require the use of a particular title company. This is particularly something to consider if you are a builder, right? Builders can't require that you use their title company, but they can provide incentives for doing so because they're the seller. A prospective buyer must be given a list of HUD-approved counseling agencies with specific carve-outs for reverse mortgage and timeshare transactions. Now, what are settlement services? Settlement services are defined under RESPA as a very broad category of any service that a borrower must pay when they close on their loan. Some examples of settlement services include origination, loan processing and underwriting fees, appraisal fees, title fees, attorney's fees, doc prep, notary, recording fees, credit report fees, homeowners insurance premiums, flood insurance premiums, mortgage insurance fees, real estate agent fees, and property taxes. That's a long list, but understand that a settlement service is essentially anything that the borrower is getting charged for when they're closing on their loan. So if they're paying for a credit report, that's a settlement service. If they're paying for a property tax, that's a settlement service. And understand that these settlement services may also be prepaid. So if a borrower pays out of pocket for an appraisal, that would be a prepaid settlement service. And that's important to understand. It's still a settlement service, even if it's prepaid or the borrower paid it out of pocket. Now, in terms of the borrower's required information on the application, a completed application occurs when 6 pieces of information have been identified or 6 pieces of information have been provided. We use the acronym ALIENS to remember this, and that is the address, the loan amount that they're seeking, their income, the estimate of the property value, the name, or the social security number. Once you get that 6th piece of information, that is now a mortgage loan application, and there are disclosure requirements associated with that, meaning that we have to issue them the GFE or the loan estimate. But we'll talk more in depth about the GFE loan estimate when we get into TRID, which is the love child of TILA and RESPA, Regulation X and Regulation Z. Now, in terms of the foreclosure process, a servicer has to establish or make a good faith effort to establish live contact, and that's generally a phone call, with a delinquent borrower within 36 days of that borrower going delinquent. Now, after 45 days, the servicer must issue a written notice to the borrower about their loss mitigation options. What are loss mitigation options? That usually includes a loan modification or other workout plan in order to allow the borrower to stay in their home. Now, a foreclosure itself cannot be filed, a foreclosure action cannot be filed until a borrower is at least 120 days delinquent. The idea here and the spirit here being that the borrower will therefore have time to work with their servicer to resolve that delinquency. They might be able to complete their loan modification before the home is foreclosed on. Now, another thing that RESPA requires is an initial escrow statement. And there's a few things to note here. The first thing to note is that the borrower will receive an annual analysis of their escrow account each year. This is called aggregate analysis, or it's known as annual escrow analysis. You may see either one, but it's to make sure that the servicer isn't over collecting for the escrows on the mortgage account, so that they can charge what's called an escrow cushion, and that would be up to 1/6 of a year. I know it's weird to say 1/6 of a year, but it's really up to 2 months. So the property taxes, homeowners insurance for up to 2 additional months. And that cushion is established in order to cover unanticipated expenses. Now, in terms of that initial escrow statement, the borrower must receive that initial escrow statement within 45 days of their closing on their loan transaction. And that annual escrow statement must be provided to the borrower each year. Usually that's provided in December at the end of the year that it's usually completed, but it could be completed at any point in the year. Any difference, so if the servicer finds that they have been overcharging for escrows, anything more than $50 will be returned to the customer. So you'll receive a check for $50 or more if there is an overage in the escrow account. We talked about a lot. What must you absolutely know about RESPA? Here we try to take everything and boil it down to the most important things. What's the purpose of RESPA? The purpose of RESPA is to ensure that consumers get timely, meaningful disclosure of settlement costs. How do we do that? Timely. How do we make sure they get timely disclosure of settlement costs? Well, timely means that we're issuing that information as soon as we have those 6 pieces of information. And meaningful disclosure, right? That means that they're getting disclosures that are accurate, and we're doing that through the good faith estimate or through the loan estimate. How do we eliminate kickbacks and referral fees? By making them completely prohibited. These fees increase closing costs. They do nothing for the borrower. How do we eliminate that? And that is by ensuring that fees are charged for services that are actually performed. We can't charge fees for services that are not performed. And finally, how do we protect borrowers during servicing and foreclosure? Well, we protect borrowers during servicing through the escrow account analysis, through your initial escrow statement, through your annual escrow analysis. And then how do we protect borrowers during foreclosure? We protect borrowers during foreclosure through the timing requirements, right? We have to make live contact within 36 days. We have to send them a written notice within 45 days. And then finally, we can't even start foreclosure proceedings until they're at least 120 days delinquent. That gives time for workout options to occur. What does RESPA cover? It applies to most federally related mortgage loans. That's going to be 1 to 4 family residential. Remember, it also includes co-ops, condos, as well as manufactured homes, as long as those are on real property. Note that it does not cover commercial or temporary construction or vacant land loans. Now, what are the key disclosures under RESPA? Well, the first one's going to be the servicing disclosure statement. It says if the loan is going to be transferred, if we intend to transfer that loan. Another key disclosure should be the affiliated business arrangement disclosure. If we're referring settlement service to a related company, what is related? That's going to be 1% or more common ownership. Similarly, we have the initial and annual escrow statement. It's going to detail the escrow account activity. That makes sure that everybody's playing fairly when it relates to escrow, that we're not overcharging, and that we are being fair and transparent. Now, finally, what are the prohibited practices under RESPA? Well, RESPA's completely eliminated kickbacks, referral fees, or unearned fees, right? We can't charge for any of those, and any fee, any kickback is any sort of fee that is charged for services that are not performed, as well as any sort of referral fee or any sort of thing of value. It's pretty airtight in that regard. Additionally, right, we have escrow reserves that are limited. We can't just go charging substantial additional funds in escrow. We can have an escrow cushion, but that cushion is limited to 2 months to cover unanticipated escrow expenses. We can't go keep 3 years of escrow, for instance. It's 2 months escrow cushion. That's also known as 1/6. Finally, we have foreclosure protections, and that is going to be the requirement to provide loss mitigation options to borrowers when they're facing foreclosure. And again, remember that timing. That's 36 days for live contact, 45 days for the written notice of loss mitigation options. And then finally, foreclosure proceedings not starting for at least 120 days after the delinquency. Hope this was helpful. That's our RESPA deep dive for today. If you have any questions, feel free to leave them in the comments section below. We look forward to helping you, and we'll be doing a lot more of these. Thanks.